Your wealth deserves stability, expertise, security. Your wealth deserves LGT Crestone, private wealth with over a century of global heritage.
Hello and welcome to the Global View on this Tuesday. Let's take a look at what's going on at a macro level. And in developing news, Russia has halted a grain deal with Ukraine, prompting concern that global food prices will rise. This follows a blast that knocked out of Russia's bridge to Crimea in what Moscow called a strike by Ukrainian sea drones. The Kremlin has said there's no link between the attack and the decision to suspend the grain deal. The White House says Russia's suspension of that pact will worsen food security and harm millions. Well, China's growth has been cut by the major US banks in response to data showing the world's second largest economy grew at an annual pace of 6.3% in the second quarter, well below expectations of 7.3% as demand weakens at home and abroad. JPMorgan cut China's GDP forecast to 5% from 5.5%, with expectations that the construction sector will contract by 20% this year, while Morgan Stanley has trimmed its 2024 forecast for the country by 40 basis points to 4.5%. Well, the US dollar dipped against most major currencies, the Aussie dollar recovering some of yesterday's losses following the release of that disappointing data out of China. It's at 68.1 US cents. US Treasury yields were little changed as the New York manufacturing survey showed that activity changed little in July, at the same time as delivery times shortened and inventories declined steadily. The yield on the 10-year note falling to 3.81% and the 2-year holding at 4.75%. Well, given that disappointing Chinese growth data, expectations are increasing that policymakers there will roll out additional targeted easing measures. Let's get some analysis. Zerlina Zeng joining us from Creditsights. Zerlina, good to catch up with you again. Thanks so much for joining us. All right, so that growth data we saw out of China obviously did disappoint markets there. Just can I get your interpretation of what we're seeing in China at the moment with demand both locally and also offshore?
Yeah, sure. Thanks for having me here. So we have been talking about the slowdown of China's post-COVID recovery since April. And the GDP data coming out yesterday was not entirely a surprise, because if you look at on the ground, credit demand is slowing down, property construction is slowed down, so does consumption, both online and offline. And if we look at the industrial production, it is also slowing down, particularly for the privately owned enterprises. So this segment, I think the business confidence as well as consumer confidence still need to be restored by the government.
So what do you feel as though can be expected as far as the further stimulus in China?
Our hope for the stimulus measures is actually not very high, because if we look at the GDP growth number for the first half of the year, it's still 5.6%. That is above the government's targeted 5.0% GDP growth. So I think the government is still relatively comfortable with this nominal number growth rate. But the government is really concerned about the property sector. So we think there will be some measures coming out for, further stimulating the housing demand. They're directing funding into the property sector. But overall, we don't think the scale will be very large, just because the government budget constraint is quite severe at the moment.
Zerlina, there remains ongoing concern, in particular in regards to those local government funding vehicles, the LGFVs. Given they form a substantial pillar for the China's debt market there, what are the concerns that are developing in that space at the moment?
Yeah, there has been a lot of news headlines about how local government hidden debt could be a medium to long-term structure issue for the Chinese economy. I think at this moment, we are not expecting a large-scale and disorderly public bond default coming out from the sector. That is really because the government's willingness to bail out the LGFVs has been very high to avoid any reputational and credit contagion risk. What they're doing is privately negotiating some of the bank loans and delaying wealth management product payment in order to repay the public bond. So over the short term, I think the risk is not as elevated, but of course, over the medium to long term, this is going to be a major drag on the Chinese economy if the government does not have a concrete resolution.
Is it likely, though, those local financing authorities are going to be forced to rein in their borrowing, I should say?
I think the local government has their budget constraints. So the way for them to conduct more infrastructure spending is really through the off-budget platforms. So in this way, it is very hard for them to immediately stop borrowing. If we look at the historical data, despite the central government keeps saying we need to rein in hidden local government debt, the outstanding amount of debt of these LGFVs has steadily increased over the past few years. I think the only resolution for them to do so is a more balanced intergovernmental budget regime. So for the central government to distribute a more fiscal resources to the local governments.
So, Zerlina, where are you seeing opportunity at the moment in China credit? Let's take a look first at the private sector. What are you seeing there?
Yeah, I think the offshore investors or those investors in the credit market tend to overreact to headline news, a lot of macro data. And in fact, our view has always been around 5% China GDP growth. So since the start of year and the private sector, China tech has been the one that we really like because of the regulatory tailwind. We think the domestic tech regulatory environment is really normalizing, which could provide a positive catalyst for the China tech dollar bond. So within the sector, we still like Alibaba, Tencent, Meituan, Lenovo, and we think the hardware down cycle for smartphone and PC could be coming to an end. That's only also one reason we like the sector.
And what of state-owned enterprises? What are you seeing there? What are you liking?
So for the state-owned enterprises, I think the valuation has been very expensive in the credit space. That's really because we have no new supply in the Asia dollar bond, and a lot of the investors are holding on to these safe state-owned enterprises for safe carry. So the valuation has been tight. What we're doing is looking for additional yield pickup. The name we like is Chem China. So for a lot of the US investors, there might be some sanction concerns, but for those not restricted account, I think the yield pickup is quite substantial.
So overall, Zerlina, what sense are you getting, particularly from foreign investors in China? Are they perhaps going underweight but not fully exiting China at this point?
Yeah, so we have been on the marketing tour speaking with credit investors in Hong Kong, Singapore, and Malaysia. The general feeling is the market is still very much underweight China in terms of credit investment. I think it's the same story for equity. Yet they are not exiting as is because there are a lot of benchmark investors here in Asia, and they could not entirely exit from the China portfolio. What they're doing is, as I mentioned earlier, they're sticking to the very safe names, investment grade, and a lot of the investors still have very limited interest into the high yield space, especially China property.
Zerlina, thanks so much for joining us from Creditsights.
Thank you.
All right, that is the global view for this Tuesday. Just before we go, a check of where we're likely to open in just a couple of minutes' time. As you can see, SPY futures indicating we will be lower, off more than 0.25%. Stay with us. The open is just around the corner.